We are back again after a short gap. Today we will be discussing very important topic, that is capital expenditure versus revenue expenditure. Why do we need to differentiate between capital and revenue expenditure? Because few expenditures will be transferred to trading and profit and loss account expenses side. So that is revenue expenditure we will be transferring to trading and profit and loss account debit side. And few expenditures we will be transferring to balance sheet asset side. So we will be transferring capital expenditure, balance sheet asset side, deferred revenue expenditure, balance sheet asset side. Now a question arises in our mind, on what basis this classification will be done. The reasons are: number one, the incurred expenditure is either to acquire tangible or intangible item. Number two, the acquired item derives benefits. Number three, the benefits can be reaped for how much time, how long? Is it for one accounting period or is it more than one accounting period? The time factor. These are the three important points will decide whether it is a revenue expenditure, whether it is a capital expenditure, or whether it is a deferred revenue expenditure. So the first point is whether the incurred expenditure is for acquiring tangible intangible item, yes or no. Number two, the acquired tangible intangible item is deriving some benefits for the organization. And number three, those benefits are reaped for how much long time period. So here time period is very important, that is one accounting period or more than one accounting period. Now let us see when an expenditure is considered as capital expenditure. As we discussed, three conditions are important to decide any expenditure as capital expenditure or revenue expenditure or deferred revenue expenditure. Let us see what are those three conditions once again. First condition, whether the expenditure incurred is for acquiring tangible or intangible items or not, that we have to check. Second condition, that tangible intangible item is deriving some benefits for the purpose of business, that we have to check. Third condition is those benefits are available for how much time period, that is accounting period, whether it is a one accounting period, whether it is beyond the one accounting period. Now let us see about the capital expenditure conditions. Any expenditure incurred for acquiring tangible intangible items. Any expenditure incurred for acquiring tangible intangible items which are held for use in the production process or supply of goods or services or for rental purpose also or for administrative purpose. Second condition is those tangible intangible items should generate some benefits or helps the organization in generating the revenue. Third condition, those benefits are available for endurable future, that is useful for more than one accounting period. If these three conditions are satisfied, these tangible intangible items considered as tangible or intangible fixed asset. So any expenditure incurred for acquiring tangible or intangible fixed asset, that is a capital expenditure. There is no doubt at all. Let us see examples. So once again I am repeating the condition: any expenditure incurred for acquiring fixed asset, that might be a tangible or intangible, is called as capital expenditure. Let us see one example. A leather manufacturing company purchased a machinery with a life period of 10 years for production of leather bags for rupees 45,000. Whether it is a capital expenditure or a revenue expenditure. Let us see the three conditions are satisfied or not. Here, leather manufacturing company purchased a machinery. Machinery is a tangible item. So first condition is satisfied. Second point, this machinery is purchased with the intention to produce leather bags. So producing leather bags and subsequently it will be sold in the market. So what is the machinery is doing here? It is generating revenue, production of leather bags. Second condition is also satisfied. And this machinery life period is 10 years. So the asset purchased can be used more than one accounting period, useful for 10 years. Third condition is also satisfied. So any tangible item is purchased or acquired with the intention to generate revenue and useful for more than one accounting period is considered as tangible fixed asset. Any tangible fixed asset purchased is considered as capital expenditure. Hence, a leather manufacturing company purchased a machinery, so this machinery is capital expenditure for leather manufacturing company. Let us see assignment question. You have to solve this question. A dealer in machinery business purchased 10 machines at the rate of 40,000 for each for resale purpose is a capital expenditure. The question is whether this statement true or false. We request you give the answer whether this statement is true or false in the given below comment section. Until now we discussed the case 1. Apart from these, there are 3 more expenditures which are considered as capital expenditures. Let us see what are they. Expenditures incurred after acquiring tangible or intangible fixed assets. We have two situations for this. Situation number 1, expenditure incurred after acquiring tangible or intangible fixed asset initially and for the first time. So expenditure incurred up to the point an asset is put to use. Here important point we have to consider is without incurring such expenditure it is not possible to generate benefits, and those expenditure is also considered as capital expenditures. Let us see the second situation. Subsequent to initial expenditure, any expenditure incurred to increase its earning capacity level or to enhance its value. However, the condition is the earning capacity level and the value enhancement must be beyond its original capacity. The another condition is any expenditure incurred to reduce its operational cost or to reduce day-to-day operational expenses. So in this case also any expenditure incurred is considered as capital expenditure. All these three cases, enhancing the value of fixed asset and which are going to give endurable benefits, are useful for more than one accounting period. Now let us see, there are 4 cases which can be considered as capital expenditure. The case number 1, expenditure incurred for acquiring fixed asset which might be a tangible or intangible asset is a capital expenditure, number 1. Number 2, any expenditure incurred initially for the first time up to the point an asset is put to use or ready to use. Now case 3, any expenditure incurred subsequent to initial expenditure to increase its earning capacity level or to enhance its value. The earning capacity increased must be beyond its original capacity. Now let us see the fourth case. Any expenditure incurred to reduce its operational cost or to day operational expenses, then that expenditure is regarded as capital expenditure. Now let us see example for capital expenditure case 2. Case 2 is initial expenditure incurred on fixed asset for the first time up to the point an asset is put to use or ready to use, without which such expenditure we cannot derive benefits from such asset, or we are not in a position to derive benefit from such asset. Let us see the example. Overall expenses incurred rupees 4,500 on second hand machinery purchased. Let us see, asset is a tangible item and the reason initial expenditure incurred on it, that initial expenditure is for the first time before using the second hand machinery, hence it generates the revenue and useful for more than 1 year. So all the three conditions satisfied. Hence it is a tangible fixed asset with first time initial expenditure incurred on it up to the point an asset is put to use. This is the example of case 2 capital expenditure. Can you answer this assignment question? Please answer in the comment box. Expenditure incurred on demolition of building to construct a bigger building on same plot, whether it is a capital expenditure or revenue expenditure. Use the comment box to give the answer for case 2. Now let us discuss case 3. Case 3 is about subsequent expenditure incurred on fixed asset. The condition is to increase its earning capacity level or to enhance its value. The enhanced value and the earning capacity level must be beyond its original capacity. This is the important condition. Let us see one example. A machinery was purchased for 10 lakhs with a useful life of 10 years. The original capacity of the machine was to produce 10,000 units per annum. At the end of the third year, an expenditure of rupees 1 lakh is incurred for the purpose of heavy repairs and maintenance. Post repairs and maintenance, the capacity of machine is increased to 10,500 units per annum, whether it is a capital expenditure or not. Let us see. It is a tangible item, subsequent expenditure to enhance capacity beyond the original capacity. Before the repairs, big repairs, heavy repairs, when it was purchased, the capacity was 10,000 units. After using 3 years, they have incurred subsequent expenditure 1 lakh, heavy repairs purpose. And after that, the machine capacity is increased to 10,500 units. So the increased capacity 500 units was beyond its original capacity 10,000 units. Hence, enhancement in value helps generates revenue and useful for more than 1 year. Here we have already used 3 years, so the remaining life period of the asset is 7 years. Hence, it is a tangible fixed asset. Subsequent expenditure incurred to enhance its capacity beyond this original capacity. Hence, it is a capital expenditure. Case 3. Now let us see case 4. Subsequent expenditure incurred on fixed asset to reduce its operational cost or day-to-day operational expenses. Few engine parts were changed at a cost of 4,000 to get fuel efficiency. What do you mean by fuel efficiency? The fuel cost will decrease. So here few engine parts were changed at a cost of 4,000. To get fuel efficiency is nothing but the cost of fuel will be decreased. Engine is a machinery, it is a fixed asset, tangible fixed asset. Subsequent expenditure is incurred to reduce the operational cost of that particular engine. Hence, it is a capital expenditure. Tangible item and subsequent expenditure is incurred to reduce its operational cost or day-to-day expenses of the business. Helps generates revenue by decreasing operational cost, useful for more than 1 year. Hence, it is a capital expenditure case 4. Now we are giving assignment question. Please give your answer in comment box below. Money spent to reduce day-to-day expenses. Whether this expenditure is a capital expenditure or not, please comment below. We will discuss again in short these 4 cases. This case 1, if all the 3 conditions satisfied, that is considered as tangible intangible fixed asset. Case 2, tangible intangible fixed asset, we have incurred some initial expenditure up to the point the asset is put to use. This is the case 2. Case 3 is for that particular tangible intangible fixed asset, we have incurred subsequent expenditure to increase its original capacity. Case 4, subsequent expenditure incurred to increase its efficiency to reduce its operational cost. Finally, to be called as capital expenditure, any tangible intangible fixed asset is considered as a capital expenditure. For tangible or intangible fixed asset, any initial expenditure incurred up to the point the asset is put to use, so then that will be considered as capital expenditure. For tangible intangible fixed asset, further subsequent expenditure incurred to enhance its capacity that is beyond its original capacity, that is also considered as a capital expenditure. On tangible or intangible fixed asset, subsequent expenditure is incurred to reduce its operational cost. This is also considered as a capital expenditure. Now the point is very clear. What is the capital expenditure? Now let us discuss revenue expenditure. When an expenditure is regarded as revenue expenditure, it must satisfy again 3 conditions. Condition number 1, there should be an expenditure incurred for the purpose of acquiring goods or getting services or operating activities or maintenance or upkeep of asset. Condition number 2, these expenditure what we incurred must derive some benefits for the business. Third condition is time period, that is accounting period. Now let us see what are those. Condition number 1, any expenditure is incurred to buy goods or for services received, to carry out operating activities, or to maintain or upkeep of fixed assets. Any expenditure incurred to buy goods or for services received or to carry out operating activities or to maintain or upkeep of fixed assets. Condition number 2, these expenditure incurred must generate benefits or helps in revenue generation directly or indirectly. Condition number 3, very important, all these expenses are for one accounting period. For example, for the current accounting period, all these expenses incurred must be for current accounting period or only one accounting period. If all these three conditions are satisfied, then that will be considered as a revenue expenditure. Now let us discuss revenue expenditure examples. We have discussed any expenditure incurred to buy goods. So here cost of material consumed is the example. For services received, chartered accountant fee paid for audit services rendered by a chartered accountant. To carry out operating activities, office and administrative expenses paid. To maintain or upkeep of assets, repairs of machinery, repairs incurred for upkeep of a machinery. These are the examples for the revenue expenditure. Let us see whether these three conditions are satisfied or not. Expenditure incurred either to buy goods or to get the services or to run the day-to-day business activities of the business or to maintain or upkeep of assets. So all these examples satisfied this first condition. Second condition, these expenditures what we have incurred helps in generates revenue of the business directly or indirectly. Useful for the current accounting period only. This is very important. All these expenditure or belongs to one accounting period only. If all these three conditions are satisfied, what is that? It is an expenditure. It should give benefit. The benefit should be for the current period or one accounting period. Then it will be considered as revenue expenditure. Here is the assignment question for you. Expenditure incurred for removal of inventory at new site. Whether this is a capital expenditure or revenue expenditure, please mention your answer in the comment box given below. Now let us discuss capital and revenue expenditure at a glance. To be called as capital expenditure incurred to acquire tangible or intangible item, and it should derive some benefits, and that benefit should be for more than one accounting period. So then if all these three conditions are satisfied, then that will be considered as a tangible or intangible fixed asset. That is the example of capital expenditure. Any tangible intangible fixed asset always regarded as a capital expenditure. This is the case 1. What is the case 2? Any expenditure incurred up to the point of fixed asset put to use, that is also considered as a capital expenditure. What is the case 3? Any subsequent expenditure incurred to increase its original capacity, that is the case 3 of capital expenditure. Case 4 of the capital expenditure is what? Subsequent expenditure incurred to increase its efficiency to reduce the operating cost of the business. These are the 4 cases which will be considered as a capital expenditure. Now let us see what is considered as a revenue expenditure. To be considered as a revenue expenditure, it should be an only expenditure to buy goods or for services received or to carry out operating activities or to maintain or upkeep of asset, and it should derive benefits directly and indirectly, and the benefit should be for confined to only one accounting period, that is current accounting period. Now let us compare. Here in capital expenditure it should be a tangible asset. Here it is a expenditure only to buy goods, for services received, to carry out operating activities, to maintain or upkeep of assets. And the second condition is it should derive benefit. In case of capital expenditure, the expenditure incurred for purchase of fixed asset derives benefits more than one accounting period, beyond one accounting period. But in case of revenue expenditure, it is also derives benefit but confined to only current accounting period. Now let us discuss revenue expenditure versus deferred revenue expenditure. Already we have discussed revenue expenditure. Revenue expenditure is the expenditure incurred to buy goods or services, to carry out operating activities, day-to-day operations, to maintain or upkeep of assets. And it is going to give benefit only confined to one accounting period. And the example is ad published in local newspaper by a college at the beginning of academic year. It is a revenue expenditure. Now let us discuss deferred revenue expenditure. Here also expenditure incurred, but it is deferred to next year or more than one accounting period. It also derives benefit, but that benefit might not be confined to one accounting period. It is beyond current accounting period, but the estimation cannot be estimated precisely. Deferred revenue expenditure by nature, it is a revenue expenditure in the first instance, but it is deferred on the presumption that it will be of benefit over a subsequent period or periods. Depending on period, it is considered as other non-current asset or other current assets which will be considered in balance sheet asset side. Let us see an example. Heavy advertisement expenditure incurred at the time of new product introduced, considered as deferred revenue expenditure. Now we are going to discuss an interesting topic. Do you know what is the ultimate destination of capital expenditure? Let us see. Assume that this is a machinery purchased. Is a big round circle is a machinery purchased for rupees 100,000 with life period of 10 years. What does it mean? This machinery useful for 10 years. So it has satisfied three conditions. It is a tangible item. It derives benefit for 10 years. It has satisfied capital expenditure condition. Hence, it is a capital expenditure. In the beginning, we discussed any capital expenditure will be transferred in the balance sheet asset side in the year in which it is incurred. So in the balance sheet, right side is asset side. So we have taken machinery as 100,000. Now this small tiny part is nothing but we have used this part of machine in one accounting period. So used part of machinery is 10,000. How we got this 10,000? Total machine value is 100,000. Life period of that asset is 10 years. So you divide the total asset value with life period of asset. So we are going to get 10,000. So what part we have used, that value is 10,000. And the part what we have used is always deducted from the total machinery value. Now the total balance is 90,000. Once again, I'm explaining the used part of machinery. So that much value of machinery is depreciated. Hence it is considered as depreciation, and we are deducting from the balance sheet this 10,000 and the balance is 90,000. This used part of machinery is nothing but the used portion of capital expenditure, always regarded as revenue expenditure. This is very important. Used portion of capital expenditure is considered as revenue expenditure, and every revenue expenditure will be transferred to profit and loss account in the year in which it is used. Hence, the used portion of capital expenditure will be recorded in the profit and loss account left side. So this is about the first accounting period. What will happen in the second accounting period? In the second accounting period, also we will deduct 10,000 from 90 and again that 10,000 will be transferred to the profit and loss account. Up to 10 years, the same procedure will go on. So the used portion of capital expenditure is a revenue expenditure. The ultimate destination of capital expenditure is profit and loss account. So the ultimate destination of capital expenditure is also a profit and loss account. Hope you understood this entire discussion. Thank you very much for watching our video. Please like our video if you feel good after seeing this. Please subscribe our channel, that is Daari Academy. Thank you.